Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for November 9th, 2018. The market is in sideways volatile conditions, which favors bidirectional day trading and only minimal risk for directional swing trading until the market sorts itself out. But this is ideal for short-term intraday trading. On an annual basis, using NDX 260, the market is in the middle of neutral at a score of 61 out of 100. On a 10-day basis with the 10-day NDX, it's overbought at 84 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is minus 0.5%, so we're in sideways. That's red sideways, meaning that's among the worst readings of the past 6 months. The slope of the 50-day moving average is also red bearish at minus 0.42. That has negative implications for the market performance over the next 20 days. ADX is a strong 54.7, favoring the bulls because of this rebound of the past 7 or 8 days. The risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. That reading is at 1.011, so we have a favorable risk on conditions, which now is favoring the beginnings of swing trading on relative strength leaders. We take that score and look at the last 5,000 trading days, and we compute the risk Z by finding the average score and the standard deviation and then expressing that as a Z-score. And so that reading is at 0.08. And you can see the risk Z histogram. That's 90 days of that indicator. It just tipped into the green. I want you to notice that it moved as far down as minus 3 sigma during the sell-off earlier this month in October. And then when it peaked at minus 3 and started inching its way north, that was an indication of a positive swing trade time frame. And so if you look at the last 10 days, you'll notice that has been a pretty good 10-day upward move, and that was signaled by that declining volatility. In blended monthly rebalancing, you can see the current holdings for the month of November with the next reevaluation due on or about 1 December. The U.S. indexes continue to dominate. And then you see below them the current leaders as of Friday's close for the various ETF populations we track, and then the Dow 30 and business sectors, and then the ETF 200. In ETF 2, the theoretical exposure of the model is at 10%, and that's a function of this sideways volatile market that we are in. Here's a quick look at some of the ETF portfolios for blended monthly rebalancing. You see the ETF 13 consisting of the usual suspects among the world indexes, and only the Dow and the Latin American 40 are above their 4-month moving average. So only 2 of them are on buy signals. Everything else is on cash, and you can see their relative performances over the last 1 week, 1 month, 3, 6 months, and then the blend. I would notice that that Latin America, which has been relatively strong compared to the other indexes, had a negative week of minus 5%, and so it may have cracked, and because it's volatile regularly, this could be a good short-term candidate for trading. The ETF 32 portfolio expands that same basic look into some other sectors and countries, and again you see dominated by cash positions with symbols well below their 4-month moving average, and so the relative strength leaders remain consumer staples, Brazil, healthcare utilities, diamonds, and then Latin America, and everything else on a negative. Notice that Brazil also suffered on a 1-week basis along with its partner ILF, and healthcare and the diamonds and consumer staples continue to be leaders. So if the market continues to recover here on the basis of expected gridlock in Congress because Democrats own the House and Republicans own the Senate, that's usually been good for the market and good for business because they can't pass any legislation to change the status quo, and that certainty has been favorable in the past to the market. That would be the natural place to look for continued strength, and so I'll be focusing closely on the Dow in the days and weeks ahead. Among the Dow 30, you can see real strength here in Walmart, Procter & Gamble, and McDonald's. Procter & Gamble is as good gets. And so any strength in healthcare in the market in Procter & Gamble will be an automatic buy as it just closed at a new 12-month high on Friday. So I'm expecting more from Procter and as well from Merck. On the negative side, GE is as bad gets. And so it's not quite a washout pattern yet because it hasn't had any recovery. But that's going to be an auto short if it continues to suffer. And we just wonder how long that's going to be alive. Reminds me of GM 10 years ago. Among the sector spiders, the defensive plays like consumer staples, healthcare and services, and utilities have the only strength. And meanwhile, oil and gas, energy, biotech, home builders are all suffering along with the decline in the price of oil. So it's only the defensive plays that are really showing strength here. In ETF Max, this is looking at the database of about 500 symbols and taking a look at the strongest of the strong and the clear leaders. Again, natural gas, consumer staples, healthcare. Those are the sectors that are leading the world right now. And then notice the big harsh sell-off here in the VIX, so that as that volatility has continued to decline, the VIX has been suffering. And longer term, that offers the potential for some swing trades to emerge from the post-election chaos. Quick look at the market health check here. Looking at daily charts for the S&P. The vertical blue lines represent 10, 20, 30, 40, and 50 days of look-back periods. The red lines are support levels that used to be resistance but which have now held. The black channel is the 30-day RAF regression channel lagged by a day. And you can see that is sloping downward, but the 10-period channel is sloping upward, so the faster trend is up. Notice that the dragon has rolled over and rolled up, that the PSAR is now in about 9 days of continuous gains. The slope of the MACD signal line is up, so we suffered through the winter during the sell-off, and then the spring coincided with that PSAR flip, and so that was the signal for potential long side. And so we are into that move by about 6 days. It's almost back to long-term fair value at the RL270. It made it all the way back to the Bollinger Band mean. And so this is a natural resting point. I consider that to be leg one off the bottom. If this holds and the market responds favorably to gridlock, then I would expect a return to the previous swing high around 292, at which point we'll see if that's long-term resistance or if it is the start of leg three. So I'm prepared at this point to go in either direction in this market. It's not in the summer yet, so we can have a short side bias. So if market opens weakly and starts selling off, I'm happy to go short intraday, piling on weakness where I can. But if it's open strongly and takes out yesterday's high, then I'm ready to go long among the market leaders, especially if it was Pfizer, Merck, Walmart, or any of the consumer staples or the relative strength leaders. So I'm going to use the market direction intraday to steer me towards strength or weakness, and then manage the trade from there. And as long as we're in sideways volatile market, that's about as much prediction as I want to make. I predict that I'm going to be trading, and it's not until we get into bull or bear that we actually have a swing directional bias. So that's my read on market conditions right now. Favors the short-term trader, and keep your powder dry and wait for the market to sort itself out. So this is ETF2 regional report, the 10 primary indexes for the world market model. Only Latin America is above its 4-month moving average. So that puts us in the allocation model, the theoretical model, with 10% invested, 90% cash. You can see that the S&P at 44 is stronger than EFA at 32, so the U.S. is still outperforming the globals. Inside the U.S., large caps with the S&P are stronger than technology, are stronger than mid caps, and then the weakest are the small caps. The two strongest sectors are Latin America, and that should read the S&P. Two weakest sectors are European 350, and emerging markets. Among the S&P sector spiders, you can see strength in the usual suspects, staples, utilities, and healthcare, and then weakness in materials and energy. So this is clearly a defensive market that has not yet responded to the market gridlock yet. In the world market model, you can see that the U.S. is a mix between large caps strong and the Dow the strongest of all, mid caps and small caps generally weak. Asian countries all well below average, and some of them really suffering in the red. Only Latin America and Brazil are favorable among the Western Hemisphere, and Europe is mostly below average except Switzerland. And again, a mixed bag on the other asset classes as well. This is typical of a chaotic market that is sideways volatile, and so that's why I'm shortening up my time horizons, emphasizing day trading, and then waiting to see the relative strength leaders emerge once the market picks a direction, either long or short. Among the ETF top 30, from the ETF2 segment, you can see those that are in green for strength and consistency are the long-term winners. Brazil is green and white on strength and consistency, so that's been a relatively new phenomenon. And any sign of strength in Brazil, I'm willing to take as a long trade. That would be a sign that the election in Brazil has been sort of processed and they're getting back to business. And so Brazil should remain volatile, and I'm interested in both directions because it's a great trading vehicle. You can see the S&P 100 index OEF is white on strength and green on consistency, and that's an indication of a former relative strength leader that is beginning to lose traction. And so that gives me some concern for the Dow and the U.S. large caps there, so we'll be monitoring that closely. But that's typical for a market that's in sideways volatile. Moving on, the ETF liquidity report simply reports the top 30 ETFs based on average daily dollar volume of the last 30 days and shows you the ones that are both liquid and volatile enough for day trading. So if they're on that chart and their ATR percentage is in the green, then that becomes a good swing trade and day trade candidate because it's liquid and volatile. So things like the Qs, the VIX, Brazil, and technology sectors all are powerful and for intraday trading. Shifting now to the daily report from Friday for Monday, we're getting more to the tactical indicators now. You've already seen the health check, so I'll just drive on. There are no signals in channeling and overreaction. The 10-day max pain candidates, not surprising that GE is there, along with Caterpillar, Goldman, ExxonMobil, and DuPont. The 10-day min pain are the ones that have lost the least on a percentage basis from their 10-day high. And so, in a way, that can be considered relative strength because they've lost the least. And that would get us towards Qualcomm, Apple, Facebook, and Conoco. Among the daily Dow tactical summary, GE and Apple fire it better than 4-1 on the auto framer. There's a handful of dojis to consider, but the things I would invite you to look at are just how bad GE has been performing compared to the rest of the Dow, and then the good news story that is Procter & Gamble making 10-day, 1-month, 3-month, and 6-month breakouts, and then also the strength that's in Coca-Cola. Those are two very good charts along with Walmart. So if you're looking for relative strength leaders to continue their leadership, that would be the first place that I would look. If the market opens well on Monday and those symbols are performing better than the market, then that's a sign that they're getting market strength and individual company strength, and I would look to add to those positions. Among the ETF 30, we've got 4 symbols that fired on the auto framer: the VIX, gold and silver, and oil. And the last 3 are also interesting because they're on single digits for RSI2, so that typically signals a potential washout condition where it was sold off sharply for 2 days, and that may be a turning point on an intermediate basis. So we'll have them on our short list for day trading. You can see the outperformance in consumer staples on a 10-day through a 6-month, making new highs in those time periods. Daily pinch and stretch report. So this is taking a look at price with respect to the RLCO river. The first column, the most positive Z stretch, this measures the percentage move above the Bollinger Band mean and expresses that percentage as a Z-score, so it is volatility adjusted. And everything in green are ones that are more than one standard deviation above their Bollinger Band mean. That means these are extreme stretches on a statistical basis, and so I consider these either as continuation patterns, so that stretch might continue, so I'm looking to add to that position, but it could also be ripe for a reversal. So if I see market weakness and then this starting to fail, then the play is back to the Bollinger Band mean. So these are the ones that are extreme conditions. The negative Z stretch is the same thing, but now this is a stretch to the downside. So the 33% stretch below the Bollinger Band mean for GE is a 4.5 sigma move compared to its long-term performance. That's how bad this is for GE. USO is 3.5% or 3.5 sigma below, so this is an extraordinary sell-off over the last 10 days in oil. And you see Apple and Mexico also following suit. So that's a snapshot of price with respect to its river. The next two columns are the most expanded pinch box and the most compressed pinch box. This has to do with the directionality of the move of the last 30 days. And so to get a very wide river, you need to have had 30 days of exceptionally directional move. And so again, oil and GE get very wide rivers at 5 sigma wide. That's how directional this move has been. But even IBM and Caterpillar are over 3 sigma. So you get exceptional directional moves. And once again, what I'm looking for there is a strong trend that's either going to continue in that direction or can play as a reversion to the mean. So that puts these symbols in a critical state, and I'll be prepared to frame trades in both directions and play in the direction of price movement. That's especially a good idea during sideways volatile markets when that day trade direction may actually start triggering some swing trades. Among the most compressed pinch boxes, only silver is abnormally pinched, and that's a function of how directional the market has been over the last 30 days. That in general, most things have wide rivers. So we don't have any Z3 pinches or super pinches to choose from. It's just been that kind of market condition. So we're really looking for extreme moves to either continue or revert to the mean by looking at the most extreme candidates. And then we'll wait for things to settle down before we start seeing the compressed pinch boxes. The auto framer summary lays out the mechanical trade frames based on that 10-day high and mechanical range risk. And the regression line fractal framework takes a look at the difference between the 10-day regression line, which we treat as the trader's price, and the 270 regression line, which we consider to be the long-term fair value. We express the difference between those two numbers in terms of ATRs, and then the top shelf in the green represents symbols that are the most numbers of ATR below their fair value. So this would be deeply discounted value plays. So like GE right now is 3 ATRs below its long-term fair value. Apple is almost 2. In the red, you see those are the symbols that are the most numbers of ATR above their long-term fair value. This is where you typically see relative strength winners. So Procter & Gamble is 8 ATRs above its long-term fair value. That's how strong this move in Procter has been. And it's making 12-month highs, and that's what the trend is going to be until it fails. So that's why Procter and Walmart and McDonald's are all on my short list. So take a look at who's been doing the best during this period of volatility and uncertainty. Procter & Gamble, Walmart, McDonald's, Coke, and Johnson & Johnson. That's what Americans buy when times are tough. You always need hamburgers and toothpaste and then antacids, and a Coke to wash it all down with. And you can buy all that stuff at Walmart. That's why that stuff is working. So what's not to love about America? And then you see the same candidates for the ETF 100 and the S&P 100. Now, this chart looks at the daily squeezes, and these are symbols that are in a position to make a large one-day move. And so we take a look at the average range, and we compare that to how tight the range was on the last trading day. And if we have a relatively large range, but a relatively tight closing range on Friday, then that creates the conditions for a one-day mechanical pop. And you can see those that test out better than 2 to 1 simply on the basis of a one-day mechanical trade. So things like gold, consumer staples and healthcare. I see the diamonds are on there at 2.4. So that tells you that the Dow 30 is well postured for a continuation play out of Friday's doji. The Four Seasons of MACD is this relatively new strategy that we've been tracking, and we really like it. We think it summarizes and synthesizes insights from the RLCO framework. And we identify 4 seasons: spring, summer, fall, and winter. And this organizes things by season, and then where the signal line is in comparison to the Bollinger Band River on MACD. So a week ago at this time, this was dominated by the winter as everything was selling off harshly. But now this week and over the last 10 days, there's actually been some recovery. And you'll notice that the things that are excellent are early into the summer, or they're well into the summer. Things like Goldman, Merck, Coke, McDonald's, Johnson & Johnson. These are things that turned around earlier after the sell-off, and they went from winter to spring and then well into the summer. And so by watching that seasonal change among your target population of symbols, you can actually see which ones are in the life cycle of the curve that you like the best. Do you like finding things in the winter and getting them as they turn to spring? Or do you like exploiting the relative strength leaders in the summer? Do you like harvesting in the fall in order to be prepared for winter? That's how you use the allegory here, or the metaphor of the 4 seasons, to help you time the oscillations on a swing trade. Then that will also lead you to some interesting day trade candidates as well. So this is a multi-purpose tool that helps us both with swing and intraday trading. The ADX stat is another new one where I'm taking a look at the strength of trend on the daily ADX using ADX 14. We're measuring that strength of trend and looking at the Z-score, the statistical significance of that. So looking at the top line, Procter & Gamble has a current ADX reading of 39.3. That's almost 2 standard deviations stronger than its long-term average. And so that tells you that this move in Procter & Gamble is extraordinarily strong. It's historically strong. And so that gives you 2 things to think about. That if this trend continues, it could still be lots of good moves to the upside. So that's very strong potential of continuation. But at the sign of collapsing here, as people start rushing to preserve profits instead of aggressively seeking more, you could see that easily become a reversion to the mean. And so when you see a strength of trend greater than 1 sigma, that tells you this is a special condition and that you got to be ready to exploit, but also to protect, that you are in an abnormal condition. You must be prepared for either eventuality in your trading plan. So the ones that are at the bottom of this stack that are in yellow and in red are exceptionally non-directional. These are mucking along. These are non-directional. And from that indecision could come the next directional trend. And if it becomes a trend, then trend followers might pile on. And so from that period of exceptional non-trendiness, you could start to expect to see the beginnings of trends. So we'd be looking at things like Disney and Merck and Intel to see where the next directional trend could be, realizing that could be the beginning of a good swing. So I'm using the ADX and the statistics of the ADX to help me understand something about the character of the swing trades on daily charts, and then I expect to use that to help me with intraday trading targets as well. So that's the ADX stat, a new feature from Muppet Labs here. Quick look at the market mosaic. You can see in chart 1 that the 30-period regression line is still down, but that the parabolic has started to cross back to the upside. That's an indication of potential change of trend. If you look down at chart number 3, you can see the slope of the 30-period regression line in blue and has crossed over its 10-period moving average at more than 2 sigma away from the long-term average. That has always been a good sign of a potential intermediate turning point. You can see the long-term history of that on chart 2. And the last time that it did that from an extreme condition, there was a long period of about 45 days of very good swing trading to the upside. And so it just has made that move here recently. And so that suggests there's a strong possibility that the panic is over and that we're readjusting to the new gridlock in Congress, and that it's back to the normal political shenanigans, which is good for business. So I have every reason to believe, and I'm trading that way, that the intermediate swing bottom is in, and that I'm prepared to exploit to the upside. On chart number 5, you can take a look at the 10-year time series of that slope of the 30, and you can see that only one time in the last 10 years has that negative slope been worse, and that was during the financial crisis in 2008 and 2009. That's how steeply downward the last sell-off from the all-time high really was. So that was actually a pretty significant moment. And then in charts number 6 and 8, you can see the magnitude of the price volatility that went from very quiet conditions to extremely sharp sell-off. That's how serious people were considering that sell-off to be. It was right at the 10% sell-off, right at the edge of a potential bear, and that was averted by the split in the House and Senate, and back to normal political nonsense. The z-scores of the regression line slopes, I'm looking at the slope statistics of the 10, 30, and 90 to get a sense of tactical posture. You can see that the slope of the 30 in black, again, has rolled over, as we've already seen. And during this last sell-off, the red line, which is the slope of the 90-day regression line, went from +1, so a very strong bull, has come all the way down to -1, which is the potential of entering into a bear, but also the potential beginnings of the next new bullish grind. So that sell-off has created a potential for new leadership, and you already see in the bottom chart there that sell-off crossed through the river and had 2 legs down, and now this next reversion to the mean leg up has gotten us to an interesting double top. And so we're right in the middle of the river in sideways volatile markets, and so this is a critical state for the market to be ready to go in either direction on short-term and long-term. This is ideal for intraday short-term trading. It is premature to pick the new winners, and so we got to let the market settle itself out. But meanwhile, this is when intraday traders are making hay on the increased daily volatility, and we'll let the leaders sort themselves out. Right now, it's clearly consumer staples in the U.S. and the large caps, because that's what everybody has to spend money on during these critical times. So that's how we're going to be postured. Patiently wait and see, and be mostly day trading this week. That's everything that I want to cover on the daily report. The rest of it is for reference, so I'll flash through that and let you stop and look at it if you like. But details available in the rest of the report. So that's everything I want to talk about. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.